Every major war in history didn't just end up changing the borders, but changed money itself. This is part one of how war actually affects and changes our financial systems. Before World War I, most countries were on the gold standard, meaning currencies could be exchanged for physical gold. But when war began in 1914, countries realized very quickly how much they actually cost. You need huge amounts of funds for the weapons, the army, and you don't know how long the war will last. So countries like Germany, to pay for the huge cost of World War I, suspended the gold standard for the first time to fund the war by borrowing more money rather than imposing new taxes. This decision was based on the assumption that Germany would win the war really quickly. This strategy failed, however, because Germany lost the war. Therefore, after the war, Germany faced huge debts. The government then had to print more and more money to pay for these obligations. In 1923, the German mark collapsed. People will be carrying out wheelbarrows of money just to buy bread. This is known as the Weimar hyperinflation, one of the most extreme cases and example of inflation in modern history. World War I showed us something powerful, that when it comes to war, governments are willing to bend and reshape original rules just to fit their agenda. This is the first of many situations where governments have done this and has caused long-term effects for their people. Follow along for part 2 to see what happens in World War II.